Good morning, friends. Why does the price of a product settled at one specific level? Why not too high and why not too low? This answer is market equilibrium. And today I will make it very simple for you. Welcome to IEMS Global. Learn economics from zero, step to step. See the previous videos of demand and supply. Market equilibrium is a point where quantity demands equal to quantity supply. It is the price at which buyers and seller agree with each other. As you know, the demand curve is a downward sloping curve and supply curve is a upward sloping curve. When both the curve intersect at point, it is called market equilibrium. This interaction is called the equilibrium point or market equilibrium. The price at that intersection is called equilibrium price on y-axis, and the quantity at the point is called equilibrium quantity at x-axis. We can take the simple example. Suppose at $10 demand is 100 units and supply is 100 unit. So this is the equilibrium point where demand is equal to supply. Now the question arises, what happens if the price is above the equilibrium? If the price is higher than equilibrium, supply will be greater than demand and surplus will be created. Sellers cannot sell everything, so they have to reduce the price because producer have generated the surplus, and to sell the surplus he has to reduce the price, and price move back to the equilibrium point. Now what happens if the price is below the equilibrium point? If the price is below the equilibrium point, demand will be greater than supply and there will be the shortage. Now buyer compete with the seller and seller take the advantage and increase the price. Again market move back to the equilibrium. We can take the real life example for that. Think about the petrol prices, smartphones or concert tickets. When price is too low, it will be shortage of petrol, smartphones or concert tickets or anything. And if the price is too high, then it will create a surplus. The market will be automatically adjust at the market equilibrium where demand is equal to supply. Means if we take the example of concert, if the concert ticket is very high, there will be the less buyer for that. And if the price of the concert is very low, there will be more buyer. So to adjust this mechanism, there is a concept called market equilibrium, where demand is equal to supply. In this case, if the demand is more, producer will take the advantage and increase the price. Then demand will be equal to supply. If price is very high, producer will reduce the price and it will reduce till demand is equal to supply. Now the question arises, why this concept is important? Market equilibrium is the foundation of government policies, tax analysis, price control, international trade, inflation studies. So if you understand equilibrium, you can understand the market behavior, how government take the decision, how tax authority take the decision and analyze it, how we can make the price balance, how international trade can be done, and how inflation can be controlled. Now, as you have understand the market, how market decide the price, in our next video, we will study what happen when demand shift or supply shift and how equilibrium changes. Till then, subscribe for IEMS Global to master economics from zero. Thank you very much.